Welcome to KonceptCraft. Introducing the Accounting Arena book, your ultimate guide to mastering the fundamentals of accounting. Embrace the world of accounting knowledge at your fingertips. Act now, and get your copy of Accounting Arena ebook. Link is available in the description below. Keep learning. Keep growing. Happy learning. Now let's begin our today's lesson. Accounting for nonprofit organizations. Accounting for nonprofit organizations is different from accounting for profit-oriented businesses. Nonprofit organizations have a mission to serve the public interest, and they do not aim to generate profits for their owners or shareholders. Instead, they use their revenues to fund their programs and activities that support their mission. Some of the main differences between accounting for nonprofit and for-profit organizations are: nonprofit organizations use a statement of activities instead of an income statement. This statement shows the changes in net assets minus liabilities, during a period, and it classifies revenues and expenses by their sources and restrictions. For example, nonprofit organizations may receive donations that are restricted for a specific purpose or time period, and they have to report how they use those funds accordingly. Nonprofit organizations use a statement of financial position instead of a balance sheet. This statement shows the assets, liabilities, and net assets of the organization at a point in time. Net assets are divided into three categories: unrestricted, temporarily restricted, and permanently restricted. Unrestricted net assets are those that can be used for any purpose by the organization. Temporarily restricted net assets are those that have donor-imposed restrictions that expire with time, or when a certain condition is met. Permanently restricted net assets are those that have donor-imposed restrictions that never expire, such as endowments. Non-profit organizations use a statement of cash flows that is similar to the one used by for-profit organizations, except that it classifies cash flows by operating, investing, and financing activities. Operating activities include cash flows from revenues and expenses related to the mission of the organization. Investing activities include cash flows from buying and selling long-term assets, such as property and equipment. Financing activities include cash flows from borrowing and repaying debts, issuing and redeeming bonds, and receiving and dispersing restricted donations. Accounting for nonprofit organizations requires a good understanding of the principles and standards that govern this sector, as well as the specific needs and goals of each organization. By following these guidelines, nonprofit organizations can ensure that they provide accurate and transparent information to their stakeholders, such as donors, regulators, auditors, and the public.